fast forward to where one of my investors, good friends, right? I found out he was paying $1 million in taxes. And I was like, oh, okay. Well, I just went to this event. I learned all these different strategies. Like, let's see what we can do, right? And, after kind of break that is what he was doing for the income losses. So it was an interesting strategy, though. He was with the $1 million, and then so that was pretty much how I went with that. He did a lot of investment strategies to mitigate the taxes.
And how long ago was that?
Larger scale, we're talking about 3 different laws. Okay, we're talking about charitable law, we're talking about trust law, and we're talking about investment law. That's how we look at it. Now, people use investment law every day, they just don't think about it, right? A retirement account, that is investment law, believe it or not, right? And when you do it inside of your business, right, you can get massive deductions for doing so. Now, charitable law is a really cool strategy that I like to utilize for high net worth individuals, preferably I would say making like $500,000 a year in income, or if they have high capital gains. Because what we can do in those strategies is we can mitigate 60% of the AGI income. So we can get a 60% deduction off their income, and we can also mitigate 98% of the capital gains.
Interesting.
Okay? And what happens through that as well is you can actually, if you do it the right way, you can actually double dip on the tax savings, which is very rare, right? It's very rare that you can get a tax deduction and you can also mitigate on the, exiting out of that asset. So the way that strategy works is we set up a for-profit LLC, okay? And we partner that, or we're gonna pretend you're the client, right? We're gonna give you 2% of the Class A shares. Okay. So you have 2% of the Class A shares. We're going to partner you with a 501(c) donor advised fund. Okay. Now that partner is going to own 98% of that entity, but they own Class B shares. So as the Class A shareholder, right, you have full management of these LLC. You have full control of the bank accounts, full everything, right? Now, what happens is you, as the client, is say, I'm going to make an irrevocable donation to this entity. Okay, irrevocable. So you're going to donate. Let's just say it's $1 million. You donate $1 million in there, so 600,000 of a deduction is going to come off your income. Okay. And then let's say it's a piece of real estate. So now you sell it inside of that entity, you only own 2% of it, right?
Yeah.
So you're going to offset 98% of the capital gains onto that partner, that donor advised fund. Okay. So now you have effectively gotten a 60% deduction for contributing to it. And then on the back end, when you sell that, you've gotten a 98% capital gains tax free. Okay. Now here's the caveat, right? Now you have all this money sitting inside of this LLC, which you have earmarked for charity, right? You've donated it, but you want that money out, right? I mean, I don't know. A lot of people are just like, a lot of people are charitable, but not that charitable, right? Like, I mean, we're talking about $1 million there. So what we do though is we can do what's called an asset swap. So you have full control. It's as simple as putting that money in the bank account today, and tomorrow you move that money back to your personal account. Okay. And then what we swap it with is we swap it with the highly leveraged asset, such as bank funded life insurance. And that's how people are able to get a 10, 25x leverage on their money, and they pull it out. And what happens? I will say.